Sinking Fund website within 10 days. Joining the meeting, you are consenting to the recording, and your login, email, phone number may be part of the recording and made available to the public. I hope everyone understands that. The first item on the agenda is the approval of the commission's transcript from our May meeting. Do I have a motion?
I'll make a motion.
Is there a second?
Yes, I second the motion.
Motion has been made and properly seconded. All those in favor just say aye.
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 Anyone opposing this motion? Therefore, the motion is approved. I think I'm going to refer this to Christopher for comments before we move on with the agenda.
Thanks, Don. Before Floyd and Alex and Emmeline talk about the May numbers and preliminary June numbers, just a couple of data points. Total AUM in the fund as of this morning was around $601.6 million. We will be paying out monthly benefits today in the amount of 2.55 million and change. So that number will come down a little bit, and that will leave us with just under $13 million in cash, or roughly 4 to 5 months worth of benefit payments. The actuary will be coming in next meeting in September. So just wanted to remind folks of that. The meeting will be a little bit longer. And hopefully I'll have a draft report about 10 days before the meeting to review. And then lastly, I'm sure the PFM folks will talk about this, but obviously the the inflation numbers came in favorably this morning. Lowest inflation readings in quite some time. We saw 2-year Treasury yields dip almost immediately under 4.8. Stock market was up. Last I looked, NASDAQ was up over 1%. Dow and S&P were up about 0.75%. And with that, I will turn it over to the folks from PFM to go through the numbers.
Okay, thanks, Chris. Yeah, I'll try to be very brief. Taking a step back to, I think, the last time we spoke, we were, on the edge of the debt ceiling brinksmanship, when that was put to bed as we expected it would be, without a long-term solution. We'll be back at that at some point down the road. Stocks have recovered quite nicely through the end of the quarter. Interest, the Fed, rose rates, indicated a pause going forward. Rates continued to sort of go up on the open market following a volatility from the banking crisis. That has subsided again as well somewhat, I think, and the question, on everyone's mind this summer is, does the Fed, continue the pause or not? I think, and we're all waiting for today's news. And I think that kind of puts, for the time being, a little more comfort in everyone's mind. So with that, I'll turn it over to Floyd for a little more detail.
Hi, everybody. Just a little bit more detail on kind of, what's been going on with the market, how does it, and what some of the things to think about. So for the quarter as a whole, the S&P 5 had a return of 8.74, and year to date, that's 6.88%. So if you think about this time last year, we were talking about deeply negative numbers. If you think about it, we were right in the area between -15 to -20% for the S&P 5 as a whole. Now, that number sounds great, and I think that it's a really good number. But of course, I think everybody knows, diving down into the details truly matters. And what you'll notice is that out of that number, about 15 stocks are pulling a majority of this, of the return for the index. And so what does that mean? That means that 15 stocks, which essentially are all in some form or fashion linked to artificial intelligence or things that can really shift productivity, i.e., Fran, if you think about this, Board, if you think about this, take it back to last summer where I talked about unemployment, starting to see some layoffs, some things that you really need to see, and some of the key points that you really need to hear touched upon in order for companies to really start to move the needle. You actually seen that now. So you've seen that now within the companies, whether it's been NVIDIA or even Apple and Microsoft, for instance, making up about 15%, which is the largest amount that two stocks have made up of the index, almost going back to 1970. So for some of us, this is before our time on this call, but you'll notice that as a whole, it's been a very long time since two stocks have made up that big of a percentage of the S&P 500. Now, with that, also for the month and for the quarter, the Russell 2000, so small caps have roared back. If you think about it from the time that you had SVB fail, along with Signature Bank and a lot of the regional banking stress and crisis, small caps fell out of favor. All of a sudden, you do have small caps start to perform a lot better going forward. So you have that 8.13% rate of return for the month for small caps. Now, with that being said, small caps did outperform large caps this month. Over a quarter, they underperformed just because of they did not pick up steam until June. Some of the newest news has been really great, but if you project forward, what are some of the things that we're looking at and or thinking about within the market? With that, some of the things that we are thinking about would be the fact that you're still a race to the bottom between growth and inflation. So right now, as Chris alluded towards, the inflation numbers came in. Definitely, inflation is slowing down. The biggest challenge is going to be how fast is inflation going to slow down in comparison to growth. Right now, you're seeing inflation slow down faster than growth domestically, but that's not happening every other place. Internationally, developed Europe is starting to have a lot of issues where growth is falling faster than inflation, and that's negative for both stocks, but also for economies as a whole. Now, just in regards to, if you're thinking about the U.S. consumer is still strong. Spending has been robust. But behind the scenes, there's a couple things to note. The first thing to note would be is that the personal savings rate has increased, it's ticked up a little bit. It's going from 4% at about the beginning of the year to about an average rate of 4.7%. For those that are, I think that you've heard the recession bell being rung, and people saying, "Oh my gosh, it's going to be a recession." I think you've heard our tone, which is it's going to be lower growth. It's not quote unquote signaling recession, but if you were looking and saying, okay, hey, what do I see as a slowdown? What are things that do relate to some type of quote unquote recession flag? You do usually see personal savings start to tick up, and you have seen that within the first half of this year. Also, within there, you'll notice that wages have started to subside. That is a very good thing for inflation as a whole, but also for subsiding some of that rocket fueled growth that we've had in the past. Inflation, just a few caveats. Where is it really coming from? It's from the shelter component. That does take a lot longer to play out. If you were looking at goods have already started to be disinflationary. And now core services is where shelter remains in. If you look at all the other areas of core services, if you're thinking about it from a healthcare aspect, those have already started to be deflationary also. So what's really keeping it buoyed up is that shelter portion. As that shelter portion works itself out of the inflation mechanism, then you'll definitely start to see that go down even more. So that's a plus, and some things to note while people are looking and saying, hey, look, over the next 2 years, the Fed is targeting 2%, not 2024, which is what the markets always want. They want something fast to happen fast and then move on to the next thing, but it's going to be gradual at the end of the gradual for the next 2 years, according to the Fed. Last but not least, unemployment. You haven't really seen too much movement in unemployment, but what you have seen under the scenes is, if you think about it, this time last year, we were talking about it saying, hey, you do need to start seeing some of the sales come out from technology, some of that unemployment to essentially come out. You have seen it in technology. Now you're starting to see it in other areas. So if you were thinking about a slowdown, you're starting to see it other places. This signals lower growth for longer. This is something that we were expecting. So we're starting to see that now as a whole. Just thinking about it, outside of the US and internationally, you've already started to see slowdowns. Europe GDP quarter over quarter for the past 2 quarters has now been negative. So if you were thinking about quote unquote recession risk, you're starting to see it there. You've seen a slowdown in manufacturing PMIs across the board globally, which essentially means trade is slowing also. So growth is going to slow across the board. Now, with that being said, the China story has not materialized as much as people would have wanted it. But even though the China story has not materialized, there's been other places that have done well. You had Brazil, which has done well due to the fact that they actually raised rates before this year. They were able to get inflation under control. You also are seeing areas such as Mexico really start to do well within emerging markets because if you're thinking about the dynamic shifts that the shifts that were happening, where a lot of, and I wouldn't say the jobs, but in some respects, where's a lot of the manufacturing moving towards areas that are closer to us. Brazil's a beneficiary just from commodities and shipping, but also Mexico's a beneficiary from the manufacturing aspect. So emerging markets, which if you're looking as a whole, usually crashes in a time like this. As of right now, you're not seeing a crash within emerging markets, and that's a plus. Um,
I was just
Chris, or Alex, anything else that you would like me to cover?
No, I mean, not from my perspective. That was, very comprehensive. So,
No, if Nick or Fran or Don have anything else, but otherwise, Floyd, I'm good. Thank you.
Chris, I just have one question, or Floyd or Alex or whoever wants to answer, concerning earnings. Talking about slower growth, and every once in a while I'll see uh, something written, something talked about that we are going to start to see, or maybe we have, I don't know, slow down in earnings. What can we expect from that, and what effect could that have on the stock market?
I just,
So,
I was going to say, I almost asked this question myself of Floyd at the end. Playing off of overall slowdown in growth, how does that affect earnings? More so, I mean, we've seen margins recover during from during the last 2 years. They've been depressed. There have been pressures from inflation, et cetera. So margins are back up. So they've recovered there. But so now it's how does that top line grow? And I agree with you, Fran. So I was going to ask the same thing. Sorry, Floyd.
no, that's actually a really good, and Fran, thank you for that question. So you're already seeing. I look at this and saying when you're starting to see layoffs here and there, but they're not large layoffs. There's a little small where you might hear it from this company or that company. That lets you know that companies are being very mindful of their profit margins. So they're understanding that we've already expected that decline to happen. We've already prepared for it by number one, increasing the price of our goods, passing along inflation. So that's already happened. So now they're actually playing defense in a sense by saying, okay, well, what are some of the things that we can do with headcount that won't impact that will still be positive for our profit margin as we see a slowdown in growth and demand. And then, okay, if we need to do, if we do see decreases in spending, then it's not going to hurt us as bad. The positive side, if you think about a lot of companies have actually already refinanced debt at companies and even personal balance sheets have refinanced at lower rates. So balance sheets as a whole, both personally and from a corporate aspect, look a lot better. The second thing would be within there is that you're coming from historical highs back down to averages, which it's going to take. I think it's going to take steps here and there to get down back to from those historical highs back to more of your averages per se. But with that being said, the other thing that's probably going to play a part, and you heard me allude to this, is that now that the artificial intelligence and I would say push is here, I think in the past it was, one off, or you might hear about productivity. But if you really look at it from a technological standpoint, it took about 7 years for the internet to kind of catch steam and to really take a hold in regards to how companies do business. AI has done that in less than a year, and it's probably by the end of this year. You've already started to hear more and more companies mention that they're starting to find ways to incorporate AI, whether it's on the statistical side or it's on the large language processing to help it out with productivity. That's going to be a way, Fran and Chris, to where, for profits as a whole, they'll be able to bolster that aspect. It's not going to flow in day one. It's definitely going to take time. But I think that's going to be a way to where you won't see, when I made the comment about profit margins, coming down, gradually, that's where that's going to come from. But they'll still be robust in comparison to prior years.
If there are no other questions, we can, we don't, this is, I think today's date is the 12th. Obviously, with the holiday weekend, we're still waiting on some manager reports and the feed reconciliation. So we'll have a June report with a final number ready. Today's Wednesday. I would perhaps hope by the end of this week, if not, certainly by Monday. So I'll stay in touch with Chris regarding that. Chris mentioned the market value as of this morning. As of the end of, let's see here, market value that I have, I had about 604 million, I think, at the end of June, Chris. Sorry, I have to bring that back up. Shoot. I do have a calculation. Yeah, so the market value as of the end of June was 604.11 million. So that would make the fiscal year number, and this is a rough estimate, without taking into account any cash outflows, a 10.7% gain from July through June. That includes, and I think when Floyd was talking, the market had, was at a bottom, I think, around the end of June of last year. July saw quite a bit of recovery before a sell-off through the end of August, and then a big sell-off in September. So I think the market bottomed out at the end of September. So July through July wasn't the bottom of last year, but it was relatively close. So from that trough to now. Again, not back to the peak of January 22, which was, again, if you're looking at, historic values, the prior high, again, a 10.7% gain. Chris, again, I did some various calculations, taking into account 2.2 million in outflows per month. Removing that, it's, a 15.5% gain. So anywhere between 10, I think, Amanda, you're probably looking at somewhere in the 12% range or so, once flows are taken into account. And obviously that's then depends on when things happen throughout the year. But certainly it'll be in excess of, the actuarial target for the fiscal year. So that's positive. And again, I won't have the benchmark figure for that. I would expect, outperformance over that fiscal year period. The plan has remained overweight to equities. Equities have significantly outperformed during that time. The bulk of active managers have also done well during that period. But again, here what we have on the screen is the May 31st report. So this is generally more organized around, again, calendar year. Just some highlights again here. And I think I'll focus more on year to date. Again, the plan in 2023, the plan lags slightly, despite the overweight to stocks as a whole. The plan is relatively neutral to international equity, overweight to U.S. as a whole. Within that U.S., the plan is also overweight to small cap. And as Floyd mentioned, again, at least through May, year to date, Small cap, as you can see, pretty significantly lagged the large counterparts. That trend reversed in June and has persisted as well here in the third quarter. So I would expect, some of that underperformance on the year-to-date basis to be clawed back by the time we see the June 30th report. From an active management standpoint, on a year-to-date basis, PineBridge, it lagged slightly for the month, slightly on a year-to-date basis. We're not overly concerned there. I think the major active manager year-to-date that has exhibited some underperformance is Acadian. Their trailing figures look quite strong. It's been, like I said, an issue really over the last, 2 months, or excuse me, as of May. May was a rough month and prior. So, again, on a fixed income basis, I think if you want to just go down, what are we looking at here? If you want to go down one more page, here's fixed income. Again, year to date for the quarter or for the month, slight outperformance. Year to date, again, pretty solid outperformance. I think a lot of it is coming from the spread sectors, investment grade credit and high yield. I think, Sky Harbor, again, relative to their specific benchmark, has exhibited slight outperformance year to date. Not a lot of other, again, concerns. I think Barksdale is maybe the one fund year to date that is a basis point or two behind net of fees. So, again, I would expect total fund on a year-to-date basis to be a little bit closer to the benchmark as of the end of June, just based on asset class understanding. We'll see what the active managers have turned in. I would imagine, hopefully they've continued, positive, the trends. Other than that, I think not too much to report on the managers themselves. Copeland has exhibited, strong performance year to date. They've been added to, a number of third-party platforms. We're monitoring, the size of that strategy, but we don't have concerns yet. They've exhibited from high-quality dividend payers, or they've benefited from high-quality dividend payers, in a year where rising rates can erode some of the value of the lower quality dividend payers that aren't growing their dividends with regularity. So, I think they're one of the highlights. Again, we're keeping an eye on Acadian, but no move to watch list or anything there. And that's, again, where things were. We'll follow up as soon as June 30th comes out. So yeah, I'll leave it for any other questions, thoughts.
Are there any questions?
Not for me, Don.
Christopher, where are we?
I think that's all we have for today, Don. Relatively short meeting. I'll get the report out on the fiscal year final number once I get it and have a chance to go over it. Hopefully, like Alex said, by the end of the week or Monday. I mentioned the actuary meeting in September. And obviously, if anything important comes up in the interim, I will continue to keep commissioners and their designees updated promptly. But that was all I had for today.
Well, thank you everyone for joining the meeting. It was pretty short. Is there a motion for adjournment?
Make a motion.
Second?
Yes, second the motion.
All right. See you guys later. Thank you very much.
Take care.
Thanks, everyone. Have a good one.
Thanks, everyone.
Bye-bye.
Thank you.